Alright, listen up, my brain rot crew. Let's talk about a reality check today. Most of you probably got into trading because you saw a screenshot of a massive green god candle and you thought that this is it. This is my ticket to a Lambo and a life on a beach. You probably think it's a quick money making machine. Just open a chart, find a green line, press green candle, press buy and wait for the magic to happen. Well, here's the cold and hard truth for you. That fantasy is the reason why a shocking 99% of traders lose all their money in the start of in the first year of their trading. They come in thinking that it's a game. It's a game of luck and or a race, and they get absolutely crushed by the market. Trading is not a lottery ticket. It is a skill, and like any skill, whether it's learning to play guitar or becoming a professional athlete, you either learn it slowly and survive, or you rush it and burn out faster than a match in a hurricane. Today, I'm not giving you some magic bullet strategy or a secret indicator. I am giving you something far more valuable. 5 core trading principles. These are not surface level tips. Okay, you've heard 100 times. These are fundamental habits and rules that, if you have discipline to follow them, can decide whether you are trading the next year or you're wrecked. So get ready to take notes. Tip 1. Protect your capital like it's your last dollar. The single biggest mistake most new traders make isn't just bad analysis. It's simply blowing their account before they even get a real chance to learn. Think of your trading capital like an oxygen tank, for example. For a deep sea dive, every single trade you take is a breath. If you take massive, greedy gulps of oxygen, you'll find yourself at the bottom of the ocean, out of air, in a matter of minutes. This is why professional traders only risk around, you could say, 1 to 3% of their money or of their account per trade. That's not a random number, it's a survival zone. Okay, imagine you're starting with a modest $1,000 of an amount. By just risking 2%, that's $20 per trade. You can lose an incredible 50 trades in a row before your account is completely wiped out. Now think about that. Even if you're horrible in all ways, horrible trader, that gives you 50 chances to learn and 50 chances to get it right. Compare that to someone who risks 20% of his portfolio on a single trade, a few losing trades, and they're staring at an empty account. The reality of trading is that losing streaks are not a maybe, they are absolutely guaranteed. The market will certainly humiliate you. It's just a matter of when. You might win 10 trades in a row, be happy, and then lose the next 5. That's just how probability works. The difference between surviving and quitting is how much you risked when those inevitable bad trades came. Remember the brutal math. Lose 10% of your account and you only need 11% to get back to even. If you lose 50%, You need a staggering 100% return to recover. Protecting your capital isn't playing scared. It's called being smart. It's about giving yourself time. You need to actually get good at trading. So stop risking your rent money. Okay? Now, tip 2. Have a real reason for every trade. If you find yourself taking buy or sell because you just have a good feeling or because a YouTuber said you to do it, that is not a good reason, dude. It was not a good idea. A solid reason for every trade is based on something real, something you can point to on a chart and say that is my setup. It has to be specific, identifiable from a trading plan that you've backtested and have confidence in. Maybe you have spotted a bullish flag, like a pattern that looks like a small downward sloping rectangle after a sharp price surge. Or maybe you see a double bottom pattern where the price drops to the same low price twice before bouncing and refusing to let it fall further. Or you're trading after a moving average crossover where a short time line crosses above a long term one. Whatever your reason is, it has to be something that you can point to a chart. This discipline keeps you from chasing absolutely random, meaningless price movement without knowing shit. It forces you only to take trades that fit your proven plan. Seriously, stop guessing. You're not a psychic. You're not gonna guess what's gonna happen next in the market without a plan. Tip 3. Control your emotions before they start controlling you. The moment you let your emotions take the wheel, your account is in big danger. Fear and greed are the two most common account killers. Fear makes you chase a winning trade way too early, close a winning trade way too early. You see a little pullback, you panic and take a tiny profit, only to watch the price continue to soar without you. Or maybe greed. Greed makes you hold on to a winning position for way too long. After your target has been hit, you get complacent, hoping for an even bigger win until the market suddenly reverses and now you're in loss. And then there's the most destructive motion of all, revenge trading. You take a gigantic loss, you get angry and immediately jump back into the market to try and win back your money. This almost leads to even bigger losses in a vicious self-destructive spiral. You can maybe double your losses. Picture this. You buy a stock at $50. It climbs to $52. You're in profit right now. But instead of taking it, greed takes over. You hold out. You say that it's going up. It's gonna go higher. You say that you're gonna sell at 55. And then something sudden happens. It drops back to $49. And your profit is gone. Now you are down, you have nothing left, and you just lost your money. The key is to have a plan and stick to it. That means setting take profit targets and that you respect and walking away from your screen after big emotional swings. If you can't handle a little pullback, maybe stick to a savings account. That'd be good for you. Tip 4. Plan your exit before you enter. This is perhaps the single most overlooked principle. Most traders obsess over finding the perfect entry, the perfect one. They'll spend hours, days, weeks waiting for the perfect time to buy. But once they're in, they're completely lost. They don't know shit that's going on. Okay, they have no idea where to take profit. This is a recipe for disaster. You should always know your exit before you click buy. For example, if you're going on a breakout at $100, your plan isn't just to enter, it's to sell at $105, just a 5% gain, okay? And to cut your loss, if it drops a pack at $98, without this predefined plan, you're making every decision in the heat of the moment, which usually means you're letting emotions take the wheel again. Okay, look at this chart. On the left, the trader jumped in without a plan. No take profit, no stop loss. Price shot up. Oh, so happy. Then got it tanked again, and they just kept holding. They saw it. They've watched their loss grow. Now look at the right side. This trader had a plan from the start. He knew where to take the profit, where to stop your loss. Price went up, hit their target, and boom, the trade was closed right there. No stress, no guessing, no should I sell this or should I hold this, panic, no, nothing like that. That's the difference. Without a plan, emotions take over. With a plan, you just follow it. So stop trading like you're trying to win a game of goddamn chicken. Okay, now tip 5, the last one, and you could say the most effective one. Do not trade right after big news. When big news drops, interest rate, like you could say interest rate decisions, inflation, tariffs, political announcements, the market doesn't act rationally. It just loses its mind. 1 second it's shooting up, the next second it's going down and don't even know where it turned around. It's not just the people like you and me buy and sell. It's bots and institutions reacting upon those decisions in milliseconds. That's when you get these volatile candles, these crazy candles, these gigantic spikes. The kind where 1 minute covers the same distance a whole day would normally take. Spreads blow up, liquidity vanishes, and you can get hit with brutal slippage that you were not expecting. Where your order gets filled at a much worse price than you actually intended. Now here's the kicker. Even if you think you know how the price is and the graph is going to react, it often does the exact complete opposite. If there's a positive report, the market, you think it's going up, it's going to go up, price tanks. Bad news, you think it's going to go down, price goes up. Why? Because the market moves on expectations, and the big players have already positioned themselves before you even heard that news. Okay, so you see this? The massive drop right here. That was Ethereum falling after the news broke out about the new tariffs on India. The entire crypto market lost millions because of a single political announcement, which created a wave of uncertainty. Look at it. Price went from here to here, just like that. And if you had a leverage position, you were probably wiped out in seconds. So the best move, wait, let that first wave of chaos pass out, watch how the market digested, see if the price action calms down, and then think about entering. Sometimes that means waiting 15 minutes, and sometimes it means waiting a whole day. Think of it like a storm. Right after it hits, stuff is flying everywhere. You don't step outside until it's safe, right? It's the same thing here in trading. So save yourself the headache and don't be the hero for the market. So these are the 5 trading tips that for every beginner should follow to be trading the next day. See you in the next video.